the Fed prefers to look at the core measure of inflation because it strips out significantly volatile components like food and energy that interest rate hikes simply don't have much of an impact on. They're far more affected by supply and demand than they are on cost. So we like to look at the core number, and that spiked to an annualized rate of 6.6%. On a monthly basis, it was over double the street consensus forecast. So, JD, this illustrates what we spoke about yesterday, and that is where producer price inflation was faster than expected, largely because of what we can see as embedded costs in the services sector. That is really why we are seeing the spike in core consumer prices. And it unfortunately cements the Fed's singular fear that these inflation dynamics are going to find themselves sticking into larger and broader portions of the US economy, fueled in part by rises in average earnings and paychecks and the tight labor market, and therefore likely to remain for a longer period of time. In other words, if they are embedded to such a degree that they become consistent rollover predictions in terms of how we see inflation going forward, they're much harder to pull back in terms of from the Fed's rate hike reaction standpoint. And therefore, the Fed feels it will need to get more aggressive and hold rates at a higher rate for longer as a result.
What is an example of what some of those costs would have been to contribute to the PPI data, which helps at least a little bit explain or set the scene for what we have today?
Largely and ultimately, it's going to be in the labor cost construction, JD. Effectively, it's just much more expensive to bring a new person on, to hold them in place in a job when there are so many more options for people to execute and therefore increase their paychecks as a result. So that seems to me the biggest component of that embedded services levels pressures. But what we are also seeing is just spikes and upticks in heretofore unknown parts of the economy or unexplained parts of the economy. And by unexplained, I mean the fact that they are spiking isn't necessarily something that people predicted. So, whilst we saw declines in clothing prices as a result of the discounting that many of us experienced over the summertime as big companies got rid of inventory, and as we saw gas prices tumble as a result of the decline in global oil prices, we also saw upticks in things like vehicle insurance costs, which was a bit extraordinary, with companies charging us more heading into the hurricane season. New car costs were also higher. That is a result of a few issues. Firstly, demand. Secondly, supply chain disruption, which makes putting cars together even more expensive than they typically are. And again, labor costs, which are rising in a significant way. The US dollar index, of course, is also rising. The dollar is on a strength that we haven't seen in about 2 decades. And that, of course, also adds to the wage pressures that we're seeing too. So collectively, those things are finding their way into the economy and staying there. It's much more difficult to cut someone's pay than it is to increase it. So pulling back on those wage increases and therefore pulling back on salaries, it's not something that we're likely to see anytime soon, even if the Fed were to continue on its inflation fight and its rate hike path.